Hello friends, welcome to yet another lecture of cost and management accounting. Today we are going to discuss about standard costing or what is called as variance analysis. Myself Dr. C. A. Vishwanathan Iyer, and I would try to interpret this topic in front of you in the easiest possible manner. What is standard costing? Before we even understand the meaning of the term standard costing, let me share with you that in cost accounting, there are various topics, various methods to calculate cost. Like you prepare a cost sheet, we have process costing, we have contract costing, job costing, so on and so forth. But there are only two methods for evaluating the cost. One is standard costing and other is marginal costing. Let us concentrate on standard costing. If we understand the meaning, it says that standard costing is the practice of estimating expenses in production process since manufacturers cannot predict actual cost in advance. Generally, to plan something which is coming up in future, we mostly probably use standard costing. We try to make a budget and then compare the standard values with the actual values and try to find out where the difference occurs. In statistics, the word difference is called as variance. Primarily, if we understand the words cost, we know that cost primarily involves three major headings: material, labor, and overheads. In business, cost control is one function which is very important and needs to be practiced by every business. So, standard costing in a way helps to first understand our cost, second, compare it with actual and budgeted one, and third, understand why the difference actually occurred. So we have material variances, we have labor variances, we have overhead variances. But the syllabus of ours restrict ourselves only to material and labor. Let us explore both the topics. So if I talk about material variance, the basic variance will be called as cost variance, which will be due to two major factors. One is the rate and other is the usage. So we have material rate and material usage variance. To explain this in the form of an equation, we can say material cost variance is equal to material rate variance plus material usage variance. How do we calculate? So you will be given the data regarding the cost incurred, the standards as well as actuals. So first you need to prepare a standard table and you need to prepare an actual table. This is very important when it comes to practical questions. If you are able to prepare standard and actuals table, then the formula for variances, if we talk about material cost variance, it is defined as standard minus actual. If we discuss about the rate variance, formula is standard rate minus actual rate multiplied by actual quantity. And when it comes to usage, it is standard quantity minus actual quantity multiplied by standard rate. I would here like to pause for a few seconds and explain these formulas. Dear friends, variance is always standard minus actual. You observe what I am sharing. If you look at the screen, in all the formulas, it is standard minus actual. Okay, the middle word of the variance, this is beautiful. In material cost variance, we have cost in the center. So obviously, we have standard cost minus actual cost as the formula. If you look at the rate variance, see the beauty. It is standard rate minus actual rate. The only multiplier factor changes, and that is where you need to be careful about. So it is multiplied by actual quantity. When it is usage, it's standard quantity minus actual quantity. So it's very simple to remember the formulas. Okay, the multiplier factor here is the standard rate. So if you are just able to remember that in rate variance it is the actual quantity and usage variance it is the standard rate, I think you can memorize these formulas quickly. As I told you, you need to prepare a standard table and actuals table before applying the above formulas. Let us take one example to understand these formulas. MBM produces an article by mixing two inputs. The following standards have been set up for the input. So we have material A, material B, which is mixed in the ratio of 40%, 60%, and their price is 4 plus 3, 4 and 3 rather. They say the standard loss in processing is 15%. My dear friends, in standard costing, let me tell you that we are always looking out for input. So our focus area should be input. Output can be anything. I repeat, output can be anything. It is the input which actually helps us to find out the variances. Since we have limited time and limited example, I am sharing only one example. Not necessary that these steps needs to be followed in all the questions. This is one of the tougher questions. Further question says during September 2001, company produced 1700 kgs of finished product or output. The actual position were for A and B given. Calculate all possible material variances. So here in this particular question, since input is not given in quantity, my first task would be to find out the input of A and B. Before I proceed further, understand when the input data is available, then only variances can. How it will be done? So calculation of input. Since I don't know input, I can assume it to be an X, I can assume it to be anything. I assume because percentage is involved, there is another simple hack that we use 100 as a assumption value. So my loss will be 15 and my output will be 85. So if input is 100, my output is 85, they have given me the output is given as 1700, so input would be obviously cross multiply, we will get the answer as 2000 kgs. But there are two things which are mixed, A and B, in the ratio of 40 and 60. I hope you remember. By mistake I have written it as X and Y, they are A and B. So we will get A 800 and B 1200 kgs. Now based on that, if I prepare standard and actuals table, the standard rate was given as 4 and 3. So with A 800 and B 1200, my standard cost of A will be 3200, B will be 3600. So my total standard cost would be 6300, 6800. It's very easy. The actual values of A and B were given as 830 and 1190 with a standard actual rate of 4.25 and 2.50. So the corresponding values will be 6503 as the gross actual cost. Now based on these two tables, we prepare or we calculate. So material cost variance, we learned it is standard cost minus actual cost. So it is 6800 minus 6503, which is 297 favorable. Now understand, variance can be either favorable or it will be adverse. Mathematically, in a cost variance, if we get a positive value, then it is called as favorable. Logic is very simple. I have spent less than what I had actually thought about. So my standard was 6800, whereas I have spent only 6503. So I have saved 297. That is favorable. Had I expended more, I would have got a negative value and I would have written it as an adverse A variance. That will come. So when it comes to rate, we have standard rate minus actual rate into actual quantity. Here you cannot directly do the valuations because there are two materials A and B that are involved. So we calculate rate separately for A and B. Now see, the A's standard cost was 4 and its actual price was 4.25. So it's minus 0.25 into 830. The answer is minus 208. So we write it as 208 adverse. One more thing, if you do calculation, it might be 207.5. Right. So what we do is, in accountancy, generally we don't write in decimals. We round it off to the nearest figure. So hence it is taken as 208. And since the value is negative, it is adverse. Whereas for B, 3 was expected and spent was only 2.5. So it is 595 favorable. So we have a negative value and a positive value. So when we add, the sum total will be 387 and the higher value is positive, so favorable. I hope I am very clear, very easy to understand. When we go for material usage variance, again we will do for A and B separately. Here the adverse is 120 and favorable will be favorable is 30. So obviously my usage variance will be 90 adverse. After you calculate the three variances separately, we need to do the verification by applying the formula material cost variance is equal to material rate plus material usage, and you put in the figures, left hand side must be is equal to right hand side. So this is about your material variances. I repeat, you always need to check the output part. Okay, you need to be very careful about it, and if you see that the output for let us say 1 unit is given to you as standard and actual production happens to be 100, then you have to revise the standards. Always understand, you have to revise the standards. That is called as standard for actuals, because the actual quantity consumed is what will be given to us in the question. So based on that, you need to revise the standards. If it is given for 1, multiply the quantity by 100, so you get standard for actuals. You can see more questions in my link tree wherein I have put in questions about standard costing so that you are able to practice it. Let us proceed further to the next type of variance as labor variance. Like material, we have labor cost, labor rate, and instead of labor usage, it is called as labor efficiency variance. Formulas, okay, it's basic. Labor cost variance is equal to labor rate plus labor efficiency. As far as formulas are concerned, it's almost similar. If you know material, it is bound to happen that you will understand the labor cost. Cost is standard minus actual, rate is standard minus actual into actual hours, because the rate we are talking, yes, let me pause again here. When I talk about rate, I am talking about per hour rate, per day rate, or per month rate, depends on what data is questioned. Here it's not per unit rate. Be careful, if per unit rate is given, you have to calculate per hour rate and then use it in the table. That is a word of caution from me. And for efficiency, it is standard hours minus actual hours multiplied by standard rate. As usual, like we saw in the material table, you need to prepare standard and actual. Let us see. Okay, so they have 20 semi-skilled workers required at 0.75 per hour for 50 hours. Likewise, they require 10 semi-skilled workers at 1.25 per hour for 50 hours. This is standard. Whereas in May 2002, the actual data was something like this. Now, when you calculate, first as usual, you will prepare standard table and actual table. Here, you need to be careful, because 20 semi-skilled workers are working for 50 hours. I repeat, 20 workers, 50 hours. So the total hours worked become 20 into 15, that is 1000 hours. It's pretty simple. We are not doing it for number of workers, or what we are not doing for 50 hours. It's the multiplication. This is called as weighted average. So your standard table will look like semi-skilled 1000 hours, rate 0.75, value 750. For skilled 500 workers, 1.25, 625, the value would be 1375. Actuals again 22 into 50 is 1100, rate is 0.50880, and skilled 8 multiplied by 50, that is 400 into 1.20480, total cost comes as 1360. So if we apply the formula, labor cost variance will be 1375 minus 1360, that is the total values. We get 15 favorable. When we look at rate, we do it separately for semi-skilled and skilled. Again you see 55 adverse and 20 favorable. So obviously the answer will be 35 adverse. In efficiency, it would be 75 adverse and 125 favorable. Obviously 50 favorable. And verification, left hand side should be is equal to right hand side. I hope that I was able to justify the entire topic. I thank you all for being wonderful listeners and practices of this subject. For all the questions that I have used or theory that I use in these slides, you can go into my link tree. I Vishu sir is my login ID, and you can definitely check for all the things. This is Dr. C.A. Vishwanathan Iyer signing off and wishing you all the best for your upcoming examinations. Thank you. Have a great day. Bye bye.